saying, but I assume that it's a lot of nothing. If you read what I wrote this morning, Mr. Besant came out and said that we're going to try to audit the Fed, or that we need to investigate whether or not the Fed is doing what it should. And I'm going to tell you right now, if you think that we're going to uncover mass corruption and all of that other fun that the libertarians believe, you're going to be very disappointed. You're just going to get 800 pages of just policy jargon. So don't go overboard on this one. Instead, focus on what the Fed is doing and focus on what Besant is doing, because as I've said a couple of times, Besant is in the driver's seat right now when it comes to expanding liquidity in the financial system. We are moving from 21% short-term issuance around treasuries, likely to 25% in the future. And as I have explained time and time again, that is rocket fuel for the markets. We are at an all-time high, 63.50 yesterday, and the momentum just continues to return to this market. We are now, I believe, closed above the 20-day moving average for 60 days. Yep, that's what a lot of capital and liquidity and expanding the M2 will do. And if you love the market at 48.50, you're sure going to love it at 63.50. All signs pointing toward continued expansion in capital. Possibility is 6,500 and possibly finishing this year at 7,100, which was what the very bullish prediction that I had at the beginning of the year. We hit the 5,500 number. We hit the 5,800 number. We got right back to 61, and now we're pushing back towards 6,500. But we've got a big 10 days coming up, and just because the projection is more liquidity, more expansion, more capital, more rally over the long term, we get these short-term sell-offs, short-term blips, and it really is a matter of helping you navigate this. This is an earnings season. When do we hit all-time lows? You're not going to get there. You're gonna, well, when it breaks, when it all breaks, when they run out of bullets. But that's going to require somewhere in the 50% range of short-term debt issuance. We don't have time for that. It's 8:48 in the morning. Let's dig into what's going on. Again, as you know, 75,000 says secret agent Charlie, I'll raise you 7501 like it's the Price is Right. But it's not just about today. This is a very important 10 days. We are in the thick now of earnings season. We have Tesla reporting tomorrow. We have all the big tech giants reporting, and we have Powell speaking today, and the Fed coming up, the Fed meeting coming up soon. And then you're going to get into Jackson Hole in August. So if you're not with us in the morning, good grief, you are the exit liquidity of this market at 9:30. So we're going to dig into what's happening in the broader ecosystem. We're going to talk about earnings themselves. I did 45 minutes yesterday in our member room explaining the importance of earnings and explaining how price movement happens. We're going to talk about a little bit of a recap on that today. I think it's very important that you understand that if this is your first time here or you've been bouncing back and forth, get in here with us over the next 10 days and definitely join us for 3 free trades and ensure that you are in here learning about earnings. This is a great reset for the markets over the next 10 days, and this Fed meeting will obviously play a big role as well. On the macro side, this is a little bit of a lot on a chart. We'll make the copy of this and throw this into the chat, but futures are flat. We're flat ahead of Powell's speech. I don't know what Powell is saying right now. I don't plan on listening to it until about 9:30, but futures are mostly flat after recent tech highs, and that's the important thing. Tech stocks continuing to drive the narrative, continuing to drive things higher. It is a repeat of 2021 all over again. Investors awaiting earnings for Coca-Cola, GM, Lockheed, and obviously Powell's speech today. Market reaction to earnings and insights from Powell on monetary policy is what we have to watch. I want you to keep a good eye, a very good eye on the 10-year Treasury yields, because that is what is driving the bus here, the risk-free rate for the markets, meaning what can I purchase knowing that I can get 4.5% compared to the earnings yield of these other public companies. Tickers to watch: KO, GM, Lockheed, RTX. Big day for the overall defense sector. Watching the SPY and the Qs. AstraZeneca, this is actually a pretty significant story here because at the end of the day, we've been watching pharmaceuticals, biotech, healthcare, lagging sector, the XLV. I did a little bit of a chat yesterday on the XLV and the impact of health insurance stocks and how they are lagging. And then how basically over time, you're going to see a lot of these health insurance companies most likely become value stocks, right? So you're going to be looking for a high F score, a lower Graham score, and the possibility of momentum returning. Be patient. But AstraZeneca changes things a little bit for the healthcare sector, largely because of this $50 billion investment by 2030 to expand manufacturing and R&D. Does that mean it's definitely going to happen? Not necessarily, but this is being announced and driven by pharma tariffs. Remember, during COVID, we did not have a lot of the things we needed. And this is a national security issue, and it still needs to be addressed. And yes, tariff policy is currently driving this, but it will alter and change things here in the U.S., and this is positive for the U.S. economy. What to watch, we're going to be paying attention to that Virginia plant, what this means for the competitors like Pfizer and Merck, and how trade policy will shape the pharmaceutical supply chains in the future. We have such a reliance on international markets for this, and I think you're going to sleep better at night knowing that certain things are made here in the United States. Open Door. We talked about Open Door briefly yesterday. It was a name that I had not seen in so long, but look at that. Hello. Once again, just a reminder, good things do happen for companies, even if they are crappy over their 20-day, 50-day moving average. And you look at this chart, you see what you see. Well, we tested, and then, wow, there's your short squeeze, there's your float, there's your move from less than $1 to $5. What does this tell us about the state of affairs? 188% move. 188% move in July as retail investors were piling in. This had social media hype. This had aggressive activist pitching. And it's important just to go back to what we talked about when it came to market tops. We're always paying very close attention to these poorly valuated companies that ultimately end up getting into the social media world. What's driving the speculation? Look for more of this in the next 10 days. All of these little tiny companies that are trading at a outrageous valuation, and use volume weighted average price and use the 20 and 50-day moving average. And we're going to dig into some of those companies today in our live room, talking about how earnings with companies like Amazon and Apple and Google and everybody else, right? How their positive news can lead to these little tiny companies that are either suppliers for them or they are adjacent to them, can end up in a quick squeeze simply because the market is looking for opportunity wherever it can. OpenAI and SoftBank scaled back their $500 billion Stargate AI data center plans, now focusing on a smaller Ohio facility. I'm just going to say this. I think there is a problem still in Japan, and I think there still is a problem with SoftBank. So I keep going back to some of the challenges and the things they keep doubling down on. At the end of the day, I'm keeping a very close eye on what SoftBank is doing. Open Doors fundamentals versus frothy momentum, that's where we are in the broader market. How this impacts SoftBank. There are a lot of people out there, and I am one of them, that looks back at what happened in Japan last year, in August of last year, and says, why do we not talk about this? How are we looking at Japan's yields increasing the way they are? How is that impacting the carry trade? How is that impacting capital flowing around the world and impacting U.S. treasuries? All of this stuff will eventually come to a head, which is why it's important to check in with us every day and recognize that our momentum reading is really about liquidity in the financial system. So as we look at this, we are green. We have 6 stocks breaking out versus breaking down. I've received a couple of questions about this. I do want to just note, this is the poor man's version of momentum. This is simply taking the number of stocks breaking out in certain conditions, plus 5%, up on the month, 5% on the week, up on the month, 1 to 2 beta. Subtracting the number of stocks down on the month, down 5% as well, 1 to 2 beta. That gives us a number. The official reading that we utilize, the one that really digs deep into the S&P 500 and the Russell 2000, has a different set of coefficients for every single sector. This goes back to a variety of different academic papers that I've tracked for roughly a decade. And it's very important to note that sometimes there will be periods where this figure is negative. However, we are positive on the broader reading. And that's one of the reasons why we talk about this in the morning. And I remind you that when we see this number go negative, that's when we turn over and look at things like the FNGD, which is that leveraged ETN. And as we've seen, every major crisis that has transpired in the financial system going back 5, 6, 7 years, the FNGD has broken above its 50 and its 20-day moving average. And what I have concluded is this is leverage in the financial system unwinding, which drastically impacts the upper tier of the S&P 500. If that is the case, another very simple thing to do, look at the SPXL. This is a leveraged ETF around the S&P 500. If that breaks under its 20 and its 50, there might be a problem. And we are still well above our 20-day moving average, above our 50-day moving average, and well above our 200-day moving average. Most recent period of that drawdown, February 24th, our signal had gone negative 2 days before that, 3 days before that. And then we had that period, that sell-off, and ultimately the insiders stepping in and momentum returning back to this market. It's not something that I'm going to recommend that you trade. It's just something that I recommend that you watch because, again, lots of bad things have happened when this fund breaks under its 20 and its 50-day moving average. And the reason that I say always pay attention to the 10-year bond is because this period back here in late 2023 corresponded with a big market downturn where the 10-year bond went to 5%. We are going to get back to that point at some point in the future, but this good old thing will remind us and tell us when it is likely going to happen and when we should take real strong shots at shorting this broader market. Stocks that are strong, housing stocks back in play. Nail, hello, you're waking up finally. I would like to see some of these stocks start to get moving. And we've been talking about housing too much for too long. We go back to the 13D filing week that we did talking about insiders and what executives were doing with their money, what hedge funds were doing with their money. And as I said, in Q1, there was a significant amount of buying in the housing sector. We are starting to just see strong, slow, quiet momentum returning to the residential construction sector. Pay very close attention to this because when nail moves above its 20 and its 50-day moving average, there's opportunity to speculate on some of these cheaper names. Toll hit our list today. Dick's, forgot about you. Well, Dick's Sporting Goods, very strong momentum. Nice bounce back from that 173 level up to 218. This kind of has Gianni written all over it, so we will ask him later today what he thinks of Dick's. Consumer cyclical stocks have been getting a lot of attention, and I've said over and over again, when momentum returns to the market, capital flows back in. The cruise line stocks do very, very well. Carnival Cruise Line, Norwegian, all of them getting upgrades in the last 24 hours. And once again, I can't even tell you if this is a properly valued company. Once again, yes, it's profitable. That's exciting. I don't know anyone going on a cruise. I do know that every time that momentum breaks down under that 20 and 50-day moving average that we just laid out, Carnival gets crushed. And when momentum returns, Carnival rallies. That's all you need to know. Follow this signal and follow Carnival. On the other side of this, energy's under pressure, and it's been under pressure for the better part of a couple of weeks, but a lot of chopping around here. Ovintiv, which is one of the better pure play players in the Permian Basin, not seeing a lot of strength. And this is that period where I like to start to take a shot to the downside on some of these names. We did that with Apache last week. Ovintiv starting to move under that 20-day. And I'm not trying to do anything over the top. I'm just trying to buy something that is at the money or in the money, and hopefully gravity does the rest of the work for me. There is a possibility that as we move toward this deadline, with tariffs, and add on the fact that the Powell's going to speak next week and they're probably not going to cut rates, that can be bearish for energy for about a week, week and a half. And then we'll see if we do have a taco trade on energy for a reversion to the upside. Looking at the OIOU, which is what we always pay attention to, is breaking back under its 20 and its 50-day moving average. That is bearish for those names like Apache, and Apache back down to 1832. I am currently still in a position that ends this Friday on Apache, and I would like to see continued down move somewhere around that 1750 range. We talked about that trade last week. Our watch list is a little different than usual, but you'll see some names. I'm not going to bring up WIMI. Well, I will. It's up at $4 now. Just continued momentum on a company that I have no idea what it does, and I just have a feeling I'm going to wake up and it's going to be at $5. Gold stock starting to see a little bit of life. GDX had broken above. IM Gold breaking above. This is at that $7 level. This is where I'd like to just buy the stock, set a stop right back at its 50-day moving average, maybe even sell a covered call out 2 to 3 weeks. We'll be talking about covered calls today in the Tesla Mastermind. This is our fourth meeting, not including the original version. There is still time to join us, but we'll be talking about covered calls and various trades for after Tesla's earnings. And now what we're looking for is the pre-positioning. Gold price is getting a little bit of a bump. Very just simple way to trade this. As you can see, IM Gold has had very nice moves once it has gotten above its 20-day moving average. Doesn't mean that it works every time, but it does give you a short-term trade. IAG Basic Materials looking for further weakness in the dollar. FSM is the same name, right? We've talked about that more over and over again. Just a momentum name, and when it breaks, it does pretty well. Just set a tight stop. Look for a possible retest of the 750 level, maybe even higher. But once again, the materials continue to rise as more liquidity enters the financial system. Two more, MGA and GM. And I got to talk about GM because it has been on our F and Graham list. Let's see if it can hold above that $52 level. If it does not, it is a likely short down to the $50 level. If it can bounce back, this is still a cheap name. And the way that we like to trade the F&G stocks, which we talked about yesterday, you break under the 20-day, you do a spread between the 20 and the 50, and you give yourself a little bit of cushion just in case it treats the 20-day as support. And if it does hold that support, we turn right back around and look to go to the upside. Final one is MGA. You know that we have been talking about Magna. This has been bouncing around. This is a proxy for our Palladium long, which I have been long since 99. Palladium continuing to rise, continuing to show strength. I know that there's a couple of you who have been trading Palladium with us, and very strong momentum right now. Pay very close attention, though, to the MFI, because if the MFI and the RSI both get into overbought territory, there may be some short-term selling like we saw previously in May and other periods of extension, simply because the CTAs will take profits and we'll see some positioning change. But I remain very long Palladium, largely based on this chart, paying very close attention to that 120 level. If we can get back above that adjusted EMA on that monthly chart, I think the sky remains the limit for Palladium moving forward. That's our recap, 9:05. All right. So if you are not a member of TheoTrade, if you are not joining us at 9:30 and going through the full market with us each day, it's important to take this into consideration because earnings 2 weeks, combined with the Federal Reserve meeting next week, combined with the tariff deadlines coming up. I don't like to speak with hyperbole. I don't like to sit here and say this is the most important Federal Reserve meeting in the history of the world. But I'm going to tell you right now, with the market as stretched as it is, the S&P 500 up at that 6350 level, all-time highs, and just burning high momentum. It's very damn important. It is a 9 out of 10, okay? It is a 9 out of 10 that these talking about these next 10 days. It is burning important. It's not 2022, and when Powell got up and spoke, and ultimately he spoke at Jackson Hole and led to a huge downturn that ultimately ended in the gilt crisis. But it's 5 alarm, and it's very important to be looking for guidance, looking for ideas, and walking through this period right now. So again, we do this every day, and earnings could not be more important because we are at this very stretched level. We are either going to have this period where earnings absolutely blow the doors off and this market just continues to bleed higher, or we see some sort of crack that is emerging from one of the bigger names. And it's important to remember that when it comes to earnings, and I'm only doing a couple of the charts today that are tied to what we discussed yesterday in our member rooms, but it is important to bring this back up, and it is important to remind you that earnings season is about resetting adjustments. It is the scoreboard. It tells us how companies did, not what analysts guessed, not what people on CNBC were suggesting is going to happen, not the two people who sit in the panel and disagree and argue over robo-taxis versus energy storage when it comes to Tesla. We know that markets are forward-looking. We know that markets track liquidity, but it's the earnings that are proof because, again, as I noted yesterday, there still are important pockets of fundamentals that do matter. Not all of it, but still very, very important. And a beat or a miss sets the tone. And even though I sit here and I will argue that liquidity is what drives markets, everyone who has a CFA and everyone who has an MBA probably disagrees. And that's the point. Just because I have a different view of the world, I have to reset and recognize that people are paying attention to this information because it shifts expectations for the markets. And forward guidance is the fuel or fire for the markets. Remember, the earnings reports are backward looking. It is the guidance that moves markets. It is the expectations that move markets. And whether it is the companies that are reporting that are providing guidance, or it is the Federal Reserve providing guidance, this is what transpires. And if companies lower their forward guidance, it doesn't matter how good their last quarter was. Traders dump, and they do it fast. Stocks don't move or good or bad. They move on surprise. And that's a really important thing to remember, right? Because we have these expectations, and some people will look at earnings reports and they'll say, wait a minute, this company beat expectations. Why is it going the other way? Or it beat low expectations, right? Very little expectations. And the stock just rips. It just runs higher. Because it's about delta versus consensus, not the absolute value that is associated with it. So this is important. You have these names, Tesla, Google, Amazon. They are not just players in their own little pockets of technology. They are the drivers of the S&P 500. And you can see it in the weighted average of the S&P 500 right here. NVIDIA is 7.9% weight of the S&P 500. Microsoft is 7.1% of the S&P 500. Apple is 6%. If these companies miss, if these companies underperform, if traders dump, if leverage is removed, the S&P 500 goes with it. The NASDAQ goes with it. And one earnings blow up can drag an entire sector, even if it is unjustified. Keep this in mind. So volatility is what we are looking for. We like earnings because they inject volatility into the system, and that creates opportunities. It sets up gap moves. It sets up setups. It gives us the opportunity to actively trade. We know how much liquidity is going to be pumping and flowing and moving when Tesla reports after the bell tomorrow, and then how the market reacts on Thursday, and then how momentum changes on Friday, Monday of next week, Tuesday of next week, Wednesday of next week. And that's just one company. Now bring in all of these big names over the next 10 days. And all of us have different ways that we trade this. I am specifically focusing and waiting for companies to report, and I want to see what happens when the market opens. Now, right now, we're seeing pre-market, Coca-Cola is selling off. I don't really even necessarily need to know what the numbers are. I just need to react to how the market is behaving. And if I get a big sell-off in Coca-Cola to start the day, and we get down here into this oversold period, that's going to be an opportunity for me to speculate to the upside using whether it's short dated options or just buying the stock and looking for a reversion. Because as I pointed out, algos love to cover when we get into that fourth or fifth standard deviation. Once again, this is all reaction to how other traders have set up their positions ahead of earnings. And that's not just traders, but also large institutional funds, hedge funds, etc. And now what happens is the band will snap for companies that are reporting, and we're going to start to see a lot of activity. Now, we've discussed this, right? There's lots of different ways to trade earnings. There's pre-positioning moves. A lot of people will make directional bets via stock or options ahead of reports. A lot of first-time traders do this, and they probably sit around and they say, this is one of the more confusing things, right? It's kind of amateur sometimes, but here's the issue. If you're buying calls expecting a big move and that doesn't happen, they beat, but the stock only goes up 2%, but you've positioned yourself for a 4% move, well, you're going to lose 100% of your bet. So remember that every single contract that is sold because of a volatility crush, something might be trading for $8. A call might be trading for $8 simply because the market expects a big move. Well, it doesn't come, and all of a sudden that $8 call is now worth $2. That's the volatility crush. And once again, a lot of funds take advantage of that and are willing to sell you these call options and these put options. So there are other types of trades, and these are the things that we talk about, right? Straddles and strangles and crush plays. That's one way to trade. One of the ways that I prefer is post earnings. I'm looking for momentum based on the beats and the misses and how the markets are effectively trading. And not just that, when a company like Domino's trades and reports earnings like they did yesterday, I'm looking at what are the other names that are associated with this that can benefit and may provide momentum moves as well, that don't have these big implied volatility moves simply because another 2 months. And those are names like McDonald's or QSR, or supply chain names like Costco, right, that are all tied to these names. Very important just to keep all of this in mind because there's a bigger game than just guessing the direction. There's all these different types of strategies that you can utilize to be successful around the period of time when there is more volatility and more capital flowing around and lots of people exiting and lots of people entering and money sloshing into these huge names that ultimately will impact the smaller names that I might be looking at, particularly on something like an F and Graham score metric. Earnings also, one last thing, are the truth, right? And they can confirm trend or trigger reversals. And once again, as you know, traders will reposition accordingly. I tell you time and time again, right? What are you looking for? What are the big things? This stuff matters not because CNBC is reporting it, not because Barron's is reporting it, but because all of these things that are being mentioned in the next 10 days, companies with their revenue and their earnings per share. Why does this stuff matter? Well, it matters because there are a variety of different things that can transpire that will explain why companies have moved the way that they did. And I went through Domino's yesterday and I explained that Domino's beat on revenue, but missed on earnings per share, EPS. And the question is, why did this stock sell off the way it did? Well, it had really good numbers. It was up 3.4% on same-store sales. It did well with global same-store retail sales, 5.6% increase, which was their best since 2023. They didn't do anything wrong. Their operational income was high. Their net income did drop a little bit, but that was driven by an investment loss and higher taxes. Their free cash flow was incredible. Their buyback is $150 billion, and their dividend's strong, yet the stock sells off. Well, if you understand some of these things that are fundamental and at the center of a company like Domino's, you would know, and I will say this, that this likely set up a buying opportunity for Domino's for the long term. And now that the company is reported and now that the market is reacting, what is the optimal type of trade to take advantage of this move down? Well, as I'm going to again explain with our Tesla conversation today, it's really about utilizing what the market is giving you. And in this environment, I'm likely going to sell a put spread down at a price I'm comfortable owning the stock 2 to 3 months, maybe even out to December, that I could set up for the long term and know I'm happy to buy this stock at 430 or I'm happy to buy this stock at 404, whatever it is. But the broader point is, now that the earnings have happened, now that the reactions have occurred, this looks like a mistake by the market, largely because, again, their losses seem to be one time. And this company is a powerhouse of cash flow, massive powerhouse of cash flow. So understanding what the company does, understanding the EPS, understanding their guidance, which looked good, understanding their margins, understanding their free cash flow, and the commentary that is tied to it. All of this creates opportunity. But these are the things that I continue to stress. You have to learn. You have to know what these things are. Because if you don't, that's how you end up in a situation where all of a sudden you're buying calls on something and the stock is selling off because you don't understand that the EPS decline may be tied to valuation compression and margin issues and things that are not sustainable for the business. Do you know that McDonald's and Griffin and the restaurant ETF, EATZ, and Yum Brands are all stocks that are strongly correlated to DPZ? Do you know what companies are correlated to Google? These are the things that we talk about each day. And these are the things that I'll be digging into again a little bit more during our live session that happens at 12:30 today. All right. Before we get out of here, just a real quick reminder about the current state of affairs. Energy stocks are the first place I'm looking at for a little bit of weakness. Right now, as I have said over and over and over again, when it comes to the energy sector, if I'm taking shots, I do not, and I stress this, do not try to target the midstream. Do not try to short the midstream. Keep your eyes on the upstream portion of oil and gas. Energy is turning negative right now. We see these moves to the downside. And if you're looking for ways to go against it, it's not going to be there, and it's likely not going to be in the refineries. It's going to be in the upstream where things are correlated strongly to oil prices, which, as we can try to get to, there we go. Oil moving lower, 1.1%. And as we barrel toward, oh, you liked that. This trade disagreement, that is the catalyst that we are watching. So again, I remain short APA, and I will remain short for at least the next week. Finally, just looking across the board, very strong momentum. Technology stocks, the stuff that remains under pressure. Adobe is not getting back up off the mat. I want you to add this stock to your watch list, because it's starting to look like and feel like there will soon be a reversion in this name and a possible move back up to 400. We're not there yet, but I want you to keep a very close eye on the RSI, the MFI, the MACD, and the ADX. And if we get 4-move crossover and retest that 20 and retest that 50, that's going to be the opportunity to go to the upside. China deadline extended, market go burr. We're going to love that, I suppose. And we'll continue to move from here. Bitcoin up 2.5%, coffee and copper. Good days, everybody. All right, I hope you guys have a good day. Thanks, Tuna Salad. Thanks, Rodney. Secret Agent Charlie, Tim, good to see you guys as usual. We will be back at 12:30, and Don is coming up right now in the next 10 minutes. He's going to throw some music on. Take the time to take advantage of the situation. I didn't even realize I had this on. Talk to you.